Welcome to the KPC Smart Money Podcast with Kevin and Karen Christ. So today we're going to talk about how to live on dividend income. You know, a lot of people, they don't exactly understand, what dividends are and how they work. And so we want to talk about that. And, there's some things you got to be careful of, don't you, Karen?
Yes.
You might start your research by focusing on companies that have consistently paid and increased their dividends for 10 years or longer.
And there's quite a few out there.
Well, my dad, I can't remember the company he cited, but my dad said he's been getting dividends. The one company has raised their dividends every quarter for 25 years. Now, it might only be a penny.
Right,
per share. But so that's the kind of track record we're looking for.
and there's some ones out there that are, well known for them. AT&T and some of the others. I mean, they have consistently given dividends. And if you're talking about, just like you talk about in real estate, it's location, location, location. Well, when you're investing for retirement, and when you start retirement is all about income, income, income. Income is what you are looking for when you get older. So how do you go about doing that, and when should you start? A lot of people say you should start earlier than your retirement years. Dividend income can be an excellent source of income, but it's important that you understand the differences. So we're going to talk about the difference between interest income and dividend income. So, Kevin, some of the stuff we're going to talk about today is what are the dividends, how to live off dividend income, and how do you build a dividend-paying portfolio, but also you need to be prepared for volatility. So why don't you jump into what are dividends?
Yeah. And by the way, unless you're really, really study investing and I would probably get an advisor to build a dividend portfolio, and even some advisors, would need to have some kind of a track record.
Yes,
that they've been around for a while and they're doing it for some other people already. And there's ways that you can check that. So let's start out, Karen, with what are dividends? Dividends. The term dividend refers to cash payments, typically paid quarterly. My dad likes the ones that pay monthly.
He has both, but yes.
Yes, he loves that. You receive them for owning shares of stock in a company. So dividends are distinct from other investment income like interest on bonds, in a couple of ways. So first, dividends are taxed at the more favorable capital gains tax rates. Let me explain. So if the capital gains rate is 15%, but you're in the 20% tax bracket, money you take out of an IRA is going to be taxed at 20% like income, whereas dividends are taxed as capital gains, which could only be 15%. So this can be really important benefit for retirees who likely don't have a lot of write-offs. At the same time, dividend investing is riskier than fixed income investing. What does fixed income investing mean? If you're living off of laddered CDs, people used to do that, 20, 30 years ago. I think people are starting to do that again now.
They are starting to do it again.
Fixed annuities, annuities that just pay a certain percentage over time, right, that you're living off of that interest. Stocks are generally more risky and volatile than bonds, whereas U.S. government bonds, by contrast, have never defaulted and are therefore seen as more safe. Now, you think about dividends that are absolutely safe or investment grade, you may not get as much of a percentage of interest, right, or dividend payment because of the risk. So a higher risk like corporate bond might pay more, but you have more of a default risk that company could go out of business. All right, so unlike interest payments, dividends are not guaranteed.
No, they are not.
Right?
They're discretionary.
And that's another reason why we want to look at companies that have a track record, right? But this very lack of guarantee is part of what makes them so powerful. Some companies have a strong track record of not only paying regular dividends, but also increasing them annually, as we mentioned before. Your dividend portfolio may be yielding 3% today, but could be yielding 5% when you retire. This hope for dividend increases is one reason why we like to include dividend-paying companies in our clients' retirement portfolios.
Yeah, now a lot of people ask too, well, how do I live off dividend income? Well, living off of dividend income actually can be a little bit tricky because you have to first focus on your spending or your burn rate, and you've got to resist the urge to buy only extremely high yielding stocks to try and match an unsustainable spending lifestyle. So you first need a budget and realize that dividend income, unless you've got an awful lot of money in dividend stocks, is not going to pay for all of your lifestyle. And in today's low interest rate environment, you want to get a diversified dividend strategy. And, a blended yield of about 4% makes sense. All right. Because if the underlying stocks are appreciating, you might get 3 to 4% in dividends, but then you might also get 3 to 4% of actual increase in the underlying stock. Well, that's a return of 7 to 8%. That's really quite good considering the risk. So dividends should just be one bucket of income that you have in retirement. You should also have many others. Most people will have Social Security, but if you could get a pension or rental income, dividend income can just help and identify. It can just be another form of income.
Okay. So now, Karen, let's talk a little bit about how to build a dividend-paying portfolio. So to build a dividend-paying portfolio, look for companies that have a history of regular and increasing dividend payments across various sectors and payout levels. Dividend increases are directly related to the fundamental performance and cash flows of the underlying businesses. Consistent increases demonstrate management's capital allocation discipline and a commitment to returning cash to the shareholders. Very important.
Mm-hmm.
So you might start your search by focusing on companies that have consistently paid and increased their dividends for 10 years or longer. I'm thinking of one company right now. I want to add something to this that, they've been paying 5.25% dividend religiously for 10 years. Unfortunately, the value of that fund,
Underlying stock.
the underlying value has decreased dramatically. So that can be the danger of trying to create income from the stock market. You're still getting your dividends, right? But when you look at what the underlying value of the fund, that could go, or stock,
Yep.
right? It could be a fund, it could be a stock, right? The underlying value of the stock could go down. An example of that is a few years ago, General Electric, which has been around forever. Everybody's heard of them, right? Good old GE. They had some issues with their insurance sector. Their Genworth policies were not doing well, and it dragged the whole stock down. All of a sudden, the stock went from $30 to $7 a share, and they cut their dividends in half. So you don't want to say, okay, well, I'm going to take $100,000 and pick this company because they pay a 10% dividend.
No, you want to diversify.
Exactly. Very good, Karen. So, the longer the history of increases, the better, of course. And it also shows a company's propensity to return the cash to shareholders. But as all investors know, past performance is not indicative of future results. That is always, at the bottom.
That's the disclaimer,
of everything,
the disclosure,
right?
Yep.
Yeah. So to filter out companies that don't have the capacity to maintain and grow their current dividend rate, you would, by eliminating companies that payout ratios exceeding their historical averages, businesses that don't generate enough free cash flow to cover their total dividend outlay, and over-levered balance sheets. Okay, let me translate.
Yeah, English.
Yeah, so there are some companies that are offering a very high dividend to get you to buy their fund to put more capital into the fund, but those dividends have more risk of going away or being cut.
So basically, a company should not be paying dividends unless they have got solid financial statements and they have enough money to pay the rest of their bills. Okay, so when you're looking for a company that will consistently pay dividends, you want to make sure that they're paying all the other things first that make them a good, sound, viable company. Because being lured into a bad investment by high yields is actually a common pitfall for dividend investors. They want the income, they want the income, they want the income, right? And so they'll see a company that's like, yeah, we got a 9% dividend, and that's
or 20%.
Or well, 20, yeah, just run, okay,
right,
yeah, but it's you got to do your homework. Why are they able to pay those types of dividends, and how long is it going to last? You know, by contrast, some stocks can actually come under temporary share price pressure, which makes them accidentally high yielders. But assuming an investor has done the necessary due diligence and has a longer time horizon, taking advantage of shares while they're temporarily low and offer a high yield can actually be rewarding over time. So we've got a few more things we want to talk about, Kevin, in regards to dividend and interest income, but we are going to have to wait till our next podcast. So thanks for listening. Don't forget to listen to part 2 next week of how do you create dividend income.
You've been listening to the KPC Smart Money Podcast with Kevin and Karen Christ. To listen to more episodes, visit kpcsmartmoney.com. You can also find the KPC Smart Money Podcast on Apple Podcasts, Google Play, Spotify, and Stitcher.
KPC Financial Solutions is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through KPC Financial Solutions, LLC, a registered investment company. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying ability of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. KPC Financial Solutions is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by KPC Financial Solutions. Hypothetical examples have been provided for illustrative purposes only. It does not represent a real-life scenario and should not be construed as advice designed to meet the particular needs of an individual's situation.